Hello and welcome to Lifestyle Dentist, where healthy, wealthy, generous dentists choose to live epic lives on their terms with freedom and fulfillment. I'm your host, Garth Hatch, and super excited for our meeting podcast today with a good friend of mine, Sam Syed. Sam is financial expert, financial planner, entrepreneur, businessman, and lover of travel and history. We'll get into that a bit too. If he could make more money as a college history professor, he would probably be doing that because he's a real history buff, which is awesome. I love history too, and learning about the world around us. And yeah, it's amazing how things just continue to repeat themselves in history. So it's good to know and learn from the past. So, and excited for the listeners too, because Sam is very knowledgeable on many different things, and I know he's going to provide a lot of value. So looking forward to this. With that said, Sam, welcome to the podcast.
Thank you, Garth. It's a pleasure to be here.
Well, we're so glad to have you, honestly. And just to dive right in, many on the call may know you, but those that don't, tell us a little bit about current Sam, what you're doing now, and then also little Sam, young Sam, you're growing up, your background, and kind of where you started.
Yeah, let's start with little Sam.
Okay,
I've always
awesome.
been pretty tall, so little Sam was also tall Sam. But started off in the UK, came from a pretty average working class family in the outskirts of West London. And I was the fifth of six boys.
That's awesome.
And loving family and just an awesome childhood. And always had a passion for finance. Always had a passion, I guess, because of the childhood that I grew up in and having little money, but also being able to help and serve other people. And so very early on, I got into a stockbroking apprenticeship in London and became a very young stockbroker. And
how old were you at the time when you did that, Sam?
I was 18 years old.
So right out of, well, I'm assuming right out of high school. Whenever, I'm not sure when that starts in the UK, but yeah, no, that is young. That's awesome.
Yeah. And so when I was 21, I had, had people leaving college and, I did all my exams in-house and it's like a college program that they provided. So I was learning and trading at the same time. It was pretty intense. I wouldn't recommend it to many people, but it was tough. And I did that successfully until my early mid-20s. And then I ended up moving to Dubai, which was a phenomenal time. I spent 4.5 years out in Dubai, and I was doing wealth management out there and really developed my passion for travel. And when I say developed, I guess earning decent money to be able to travel, but I was able to travel around the world. Emirates Airlines has a direct flight from Dubai to most places in the world. And so I had a fantastic time out there, and then eventually was headhunted, for lack of a better word, to move to New York City. And I spent 4 years in Manhattan, married a Coloradan girl, and COVID happened when she got pregnant with our first child, and ended up moving to Colorado 4 years ago. And that's where I am with present day Sam.
That's so cool. Hey, just to back up on that a little bit with Dubai, because I know it seems like there's a UK Dubai connection. I know a lot of people from the UK that even doctors and others that move to Dubai. I know it's a big financial center. Could you just tell us a little bit about Dubai and your experience there and kind of the background of Dubai?
Yeah, Dubai is a phenomenal place. It has a double tax treaty with most countries. And when I was living there back in 2012 to 2017, their tax rate was pretty much zero. So if you was a doctor in the UK and you're a successful doctor and you're getting that super tax over 50% over a certain threshold of income, that's a pretty brutal punch tax. So moving to Dubai was very favorable because you could literally move to Dubai, earn that money and not be taxed. Whereas when I was working and serving American clients, there was the FATCA Act put in place under I believe, the Obama administration. And after a certain threshold, you were taxed anyway, living abroad. So that's why it was more favorable for certain countries to and there's a big American population out there too, but that's why you see a lot of Brits moving out there, because there is a small tax, but it's significantly lower than what you'd be taxed in the UK.
That's amazing. No, that's really cool. Don't they have, isn't Dubai where they have the indoor ski resort or something like that?
Yes, I've got a crazy fact for you. I live in Colorado. I've been living here for 4 years.
Mm-hmm.
I've only skied once in my life, and that was
Yeah.
in Dubai in the indoor ski slope. so,
That's so
so I
wild.
still haven't skied in Colorado. My excuse is since we moved here, we built a house and we've had 2 kids. So I've got a
Mm-hmm.
3.5-year-old and a 2.5-year-old. So that's been keeping me busy.
That's awesome. No, it's
But
so, so,
but
so
in
cool.
the indoor ski slope, they have penguins walking around. So it's a real thing.
Unbelievable. That is crazy. So moved to New York, met your sweetheart there, got married. You've got 2 young ones now living in Colorado. What was that transition like? I mean, it may have just been because of family, but was there any other pull from New York to Colorado?
Yeah, actually, we'll probably be living in New York right now if the pandemic didn't happen. So, what happened
Mm-hmm.
was most New Yorkers probably tuning in can identify with this one, but we were living in a beautiful 1 bedroom apartment prison cell. And that's pretty
Yeah.
much how it felt. So, when
Mm-hmm.
Lauren
Mm-hmm.
got pregnant with our first child, being
Mm-hmm.
from Colorado, we thought it would be a good idea to move to Colorado, be closer to her family, and build a house
Mm-hmm.
out there. We built it just
Mm-hmm.
at the right time before the lumber prices and whatnot started increasing. But we did a decent 6. It's not like we abandoned New York straight away. We did 6 months there and realized that this will be a more difficult place for us to raise children. And I'm
Mm-hmm.
glad we did. I go back to New York often, and I'm not sure if our second child would have been born if we were still in New York. So I believe everything happens for a reason. And we got
Mm-hmm.
a beautiful, healthy young girl and a beautiful, healthy young boy. So
Mm-hmm. That's awesome. That's awesome. And I know you as a financial planner, you do expert in life insurance, stocks, bonds, various financial planning strategies. Also, I know as a businessman, you are doing a lot of really cool things, including electric charging stations. Do you want to talk a little bit about some of the different things you're doing? And then we could really dive deep into legacy and financial planning, life insurance, all kinds of different strategies that, go that direction.
yeah, of course. Yeah, so I guess the underlining fabric will always be legacy focused for me
Mm-hmm.
and
Mm-hmm.
financial planning. As I've
Mm-hmm.
got older or matured or got into the tech world, I've really specialized in tax strategies with via insurance
Mm-hmm.
vehicles and really focusing on business owners primarily and serving business owners with different strategies. I like to say that most financial advisors or insurance professionals haven't even heard of, let alone can recommend. So I can go
Mm-hmm.
into some of that stuff later. So I like to
Yeah.
consider myself more as a recovering wealth manager these days because I'm not managing money, as so to speak,
Mm-hmm.
anymore. I'm just
Yeah.
focusing on the insurance strategies.
Mm-hmm.
But what
Mm-hmm.
happened was when I moved to Colorado, I ended up co-founding my first tech company called Capsule and
Mm-hmm.
really leading on almost simultaneously from what I was doing anyway with Side Financial, which is legacy, focusing on
Mm-hmm.
legacy for high net worth individuals and for successful business owners, but legacy on
Mm-hmm.
a different level. It was
Mm-hmm.
more of a reverse engineered version of ancestry.com. So
Mm-hmm.
creating an app where you can save your memories, your stories indefinitely and
That's cool.
creating an environment that is not public facing. So it's not like
Mm-hmm.
keeping up with the Joneses and looking for likes and looking for comments and all the negativity that social media brings,
Mm-hmm.
depression, comparison, envy, jealousy, all the hatred that social media can bring, but really focusing on what's important in your life, not the
Mm-hmm.
15th picture of an acai bowl that you've had for that month or coffee, but
Mm-hmm.
real memories. And then when we
Mm-hmm.
pass away, those memories will get passed on to your loved ones. And when they
Mm-hmm.
pass away, they get passed on to their loved ones. So I like to say in 400 years time, your great, 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 great grandkids will know who Garth was in first person. And that kind of
Mm-hmm.
links to that history that we were talking about, and which we could talk about later on, and that legacy focus.
Yes.
It's an app where there's no advertising, there's no data tracking, really pure private sharing. It's a subscription based, but you get some terabytes of data that comes with that. So it's a really just a clean business model of saving, storing those memories. That was my
That's
first startup. So that was still kind of linked to Side Financial, linked to the now 19 years of financial planning that I've been
mm,
doing over, the UK, Dubai, Manhattan, and Colorado. And now
mm,
recently, what you were talking about, which is the main focus, and on at least for me on the tech side, is we are building the Airbnb of EV charging.
that's so
And you're going
cool.
to hear a lot about that towards the end of this year, towards the Q1 of 2025.
Mhm,
And that is our primary launch pad is Colorado,
mhm,
and it will then be California. But
mhm,
essentially, what we're doing, Garth, is we've created a smart box,
mhm,
and that smart box is going to be super cheap. We're
mhm,
currently in the process of interviewing US manufacturers, but we're going to
mhm,
keep it at a very competitive price, under
mhm.
$100.
Wow,
And that
that's huge.
smart box will monetize
Mhm,
your existing EV charger
mhm.
and will be able to charge other people's vehicles at your front driveway and earn a
Mm.
passive income.
That's so cool. That is awesome. Uh, Almost like a rental in your own yard or house or whatever else. It sounds like. Yeah,
Correct. Yep. And
that's so
it's
cool.
it's in your front driveway.
Yeah.
So they're not entering your, as I like to say, your personal space. They're not in your
Sure.
garage. They're
Sure.
just in your front driveway. The cars are
Right.
verified. We've got all the. It's no different from trusting someone to take you to the airport in an Uber,
Sure.
or
Yeah.
trusting someone to deliver your food, or borrowing
Mhm,
someone's car on a churro. It's that
mhm.
peer-to-peer based model.
That's very cool. That's very cool. Wow. Yeah, that's awesome. And congrats on doing that too. You sound like Elon Musk. I mean, you're providing a lot of value and affordable price.
Yeah,
That's
man,
super cool.
that's never been compared to the great Elon. So I appreciate that.
Well, one thing you hit on, which is also a big aha moment for me in life, is taxes. Because as most of the people listening to this are dentists or some sort of doctors that are listening to this podcast, and for us, our biggest expense by far for most people is our taxes.
Hmm.
And as the smart ones, quote unquote, that became professionals from doing good in school, we are actually penalized, at least in the U.S., on the tax code compared to other businesses and things like that. And so there are where there are a lot fewer tax strategies we can use, but real estate's one. There's oil and gas. There's insurance. There's some different ones, but that's got to be a big part of the strategy is taxes. You know, and on that note, what have been some different strategies that you've come across that have been very helpful for professionals, business owners to save on taxes?
So the biggest one that is so pinpointed to your audience, because
Mhm,
literally 70-80% of my clients that do this are
mhm,
successful doctors and dentists, and
mhm,
the other part is successful partners in law firms, like very
mhm,
successful partners in law firms.
mhm,
Literally those three. So you're hitting
mhm,
two of the three categories that are the biggest audience for an RPT, or
mhm,
a restricted property trust.
mhm,
Okay. In a nutshell, and by the way, just before I say this, oil and gas strategies, all these strategies are great strategies. Diversification is key.
mhm,
When you look at this product,
mhm,
I'm slightly biased because it's a large part of what I do in terms of tax strategy. I would
mhm,
arguably say it's better than most of the tax strategies out there, um,
mhm,
for two reasons. First and foremost is it's safe. It's a relatively short timescale compared to other permanent life insurance strategies.
mhm,
And you also get the added benefit of the death benefit, which you're not going to get under different traditional types of investment tax strategies out there.
mhm,
In a
mhm,
nutshell, Garth, and I can do a background on whole life insurance versus term insurance
mhm,
if you want, but this is basically the only whole life strategy, whole life insurance plan I've ever seen where you can fund it with pre-tax dollars and take it out post-tax dollars. So you fund it like a SEP IRA and take it out like a Roth IRA. So I wanted to say
Interesting.
that twice and say it in two different ways
Yeah.
because yes,
Yeah.
it's exactly what I'm saying it is. So I can go into
Yeah.
the mechanisms and there's illustrations, and this is a podcast, so I can answer the questions without the illustrations to the best I can. But
Yeah.
that is how that structure works.
That would actually be helpful because I know I personally structure with that first with term versus whole life. Right after I got married, signed up for a universal life insurance policy, felt like it wasn't fulfilling my needs, seemed very expensive. And listening to Dave Ramsey, and he says, get term, it's better to get term and then invest the difference. And since then, I have, after being in a couple different masterminds and investment groups, got a whole life insurance policy for the cash value, more for the cash value than the life insurance policy, and as a way to diversify and have an income source that's very safe, very secure from creditors or other lawsuits, other things like that could potentially take that money. But this sounds like a whole life insurance with on steroids, kind of like
Yeah.
even better than just a regular whole life insurance. So yeah, maybe just briefly your thoughts on term versus a whole life insurance policy, and maybe what might be right for people when.
Yeah, I think the biggest disservice someone can do in any industry is make a blanket statement. And that's where I disagree strongly with Ramsey's comment on a derivative or word for word by term and investor difference, because you're really limiting, you're basically saying a statement which is accurate for households that bring 50, 60, 70,000 a year and to the low hundreds, maybe like 100. And then for everyone else, actually, permanent life insurance makes a tremendous amount of sense, depending on how you're using it. If you're looking for that type of infinite banking strategy where you're borrowing from the policy and paying that back, especially for people in the property world that are buying properties and they need some extra cash, which they know they can put back into the policy. Perfect for them. People that want to leave a legacy, which is obviously the underlying theme of this conversation, perfect for them. You buy a term insurance policy for 20 years, you're 20 years later, you're like, well, I need another policy. That policy is going to be a lot more expensive. Depending on what age you are, let's just pretend you're 50 years old at the end of that, or 55 years old, you can get another 20-year policy for 75, but after that, you're pretty stuffed, or unless it's going to cost you hundreds of thousands of dollars. So making a blanket statement like that it's difficult because it's not entirely accurate, depending on what the individual or the business owner is looking for. With permanent life insurance, it's guaranteed for life as long as you keep paying the premiums. So you are guaranteeing that when you pass away, there's going to be an amount of death benefit, which is going to be passed to your loved ones or religious institution or charity or whoever you want to leave money to. It's going to pay for certain things. Or if you are going to have to liquidate some assets upon death to pay taxes, it can cover those potential taxes, and you keep your property. So really good on a death benefit perspective. But as I said, depending on how you fund a permanent life insurance policy, because you can overfund a policy. And if you overfund it, it just means that more money is going towards the cash accumulation part of the policy. So you're actually getting more cash in the policy, which you can borrow from, which some people like to call the infinite banking or whatever you want to call it, being your own bank account. But that's where it could be really, really beneficial for you. And so when we're talking about an RPT or a restricted property trust, we are talking about a overfunded whole life insurance policy. The catch is you need to be a successful business owner and you have to have a lot of taxable profits, income. And so let's just pretend a lot is generally 500,000 or more is the qualifying amount. So if you have $500,000 and you're paying taxes on that $500,000, you literally could put $100,000 a year into an RPT and you'll be taxed on $400,000 for that tax year. It literally works like that. The time scale of the RPT is a lot shorter than a typical insurance product as well. It's up to the business owner, but it's 5 years, 10 years, or 15 years. And after each 5-year increment, you can choose to do another 5-year increment, but the maximum contribution is 15 years.
Interesting. And RPT, what does that stand for again? RPT?
Restricted Property Trust.
Restricted Property Trust. Okay, no, that makes sense. And I have heard of infinite banking, and correct me if I'm wrong, but my understanding for, just say traditional whole life insurance where you're trying to maximize the cash value of a policy, typically you're going to go with one of the bigger insurance companies that's well established. You are going to get a dividend on the money that's growing and that's accumulating in that account. Say it's 6% annually, which isn't a huge amount, but it's growing tax-free is my understanding, and it's guaranteed. It's not if it is a guaranteed benefit, because you can also get like the universal where it may be a little higher, maybe a little lower depending on what the stock market does. But say we're doing a guaranteed benefit 6%, no matter what happens, you're getting that 6% a year. And the infinite banking would be, say, I want to borrow against that. I'm going to buy a new rental property, and I want to pull out $100,000 out of that policy to buy a rental property. So I would pay interest on that money I borrowed against. The money that's in the plan would continue to grow at that 6%, but I would have to pay it back to make it whole. At least I wouldn't necessarily have to pay it back, but to make that policy whole, I would pay it back at an interest rate. And sometimes that interest may be 3%. So there's a spread. Right now, it seems like it's about a wash where you'd be borrowing at 6%, you're paying it back at 6%. So it's still an easy way to get money, but it's essentially a wash. Is that kind of ballpark about right for?
I think that's a great explanation. Yeah. Obviously, depending on which carrier you're on, the percentage rate is going to be different. So I'm just going to reply with 9 times out of 10, the internal interest rate that you're borrowing from is going to be significantly better than borrowing from a bank. So if you're borrowing from a bank at 7 or 8% in today's rates, being October 2024 of this recording, and you're borrowing within the policy at a rate of, call it 2 to 4%, then there's your arbitrage. So the reason why people would borrow internally is because you're saving money borrowing from your own policy. And quite rightly said, you should be paying that money back unless you're older, and older can be any age for anyone, but let's just say you're 65, 70, and you want to start using the policy as a kind of annuity where you're paying yourself an income and a tax-free income for the rest of your life, and you're drawing down that cash value, then you can do that too. So it's got multiple uses.
Okay. And so to take it the next step, and I'm full disclosure, I do have a whole life insurance policy for the cash value. I have not set up an RPT, but when I was talking to Sam, I was very interested in it. It sounds essentially like the benefits of a whole life insurance policy for cash value, but it's with pre-tax dollars versus post-tax dollars. Is that fair to say?
Yes. And what makes this unique for anyone listening who has a basic understanding of whole life, because of the nature of how this is funded, it's extremely beneficial for the business owner. I'm just going to use round figures because I understand there's states in America
that helps.
Different tax rates. Okay. But from the top of my head and from doing these, the equivalent of putting in $100,000 is the pre-tax is the same as around 124,000 of earned income going into an investment account, which after taxes, you're putting in around $70,000. So from immediately, you've got 100,000 of pre-tax dollars worth 68 to 70,000 of post-tax dollars on a usual investment plan. And when you look at the growth to growth on both the investment side or the RPT, based on a 7% growth rate on the investment strategy year on year on year, not one down year for 30 years, which we know is near enough impossible. the RPT would actually beat an investment strategy of 7%. And the reason for that is because you're using pre-tax dollars. So that's what makes the RPT more exciting. So if there's people that have never got into, I've literally had business owners that would never go into whole life insurance for their own personal reasons, even though they admitted they could do with some of the death benefit. And then when they saw the RPT strategy, suddenly it made more sense because you're using pre-tax dollars and you're funding that policy. So it becomes a lot more appealing for business owners.
That makes sense. That makes sense. Are there certain carriers like Mass Mutual or I don't know, whatever other plans that are out there, Penn, what are there certain policy carriers that will do the RPT and not others, or is it most of them will do the RPT strategy?
There's a chance that there might be an extra carrier added as of 2025. But at the moment, and for the last 20 years, when this strategy was set up, it's only been through Penn Mutual.
Penn Mutual, got it. Got it. Well, that's cool. I'm already with Penn Mutual, so that's good to know.
Yeah.
That's a good company.
That is good to know. What's interesting about the policy as well for anyone that might have significant business partners is it's actually perfect for a buy sell. So in additional to the tax benefits, the RPT is an excellent tool for business owners looking to plan for the future. It can be used as part of a buy-sell agreement or a business succession plan. That really helps owners.
Tell me more about that. Yeah. How would
really
that be structured?
Yeah, so it just basically helps their transitions in a more tax-efficient way. And by incorporating the RPT into their financial strategy, business owners can actually reduce their tax liabilities while ensuring a smoother, more secure transfer of ownership. So when you look at a traditional buy-sell agreement, I don't know what the ratio is. I'm just going to say more than, let's just say 51% or more buy-sell agreements are done via a term insurance policy. But when you're looking at funding a buy-sell agreement with an RPT, well, now you have a successful law firm or a successful medical practice or a dental practice. Now you can reduce the taxable income, put that into an RPT, and now you've got a buy-sell agreement which can actually generate revenue, cash value for the business partners.
Oh, that is cool. On that note with business partners, because I know there's certain strategies where both partners have to do it or it doesn't work. If say you had two business partners in the same business, could one do it and the other one not do it?
Yes. So one of the biggest benefits of the RPT is it's massively flexible. So first and foremost, it can be set up alongside other corporate benefit plans, like qualified retirement plans, without actually interfering with the amounts that can be contributed to those plans. So it makes it really ideal to complement any existing financial strategies that business owners might be working with, their tax strategy, CPAs, their financial advisors. It also works seamlessly with many different corporate structures. So S Corp, C Corp, LLCs, as long as the LLC is not taxed as a single member LLC. Yeah, so it's very flexible. If you have 4 business partners and only 2 or even 1 is interested in doing it, you can do it.
That makes sense. That makes sense. From a hierarchy of strategies, because we're both in different masterminds. We're in GoBundance, a lot of real estate investors in that one. If you were to say, this is step 1, 2, 3, 4, like what would you put the priority on? I'm assuming first and foremost, invest in yourself and your business. And then would you say invest in like an RPT or invest in real estate, like rental type real estate or other stocks, bonds? What would you say? What would you say?
Oh man, I'm going to give you like the worst answer for this, like the typical CPA attorney response.
It depends, huh?
It depends. Okay. So like, here's the thing, right? It depends on the business owner and what their risk appetite is. One thing I will say, and I'll strongly defend, I will take an RPT over a bond any day. Any day. An RPT is going to beat a bond. Unless your bond is a junk bond in an emerging economy that is war driven, and you're looking at getting double digit returns from your bonds, but you might not see the coupon. That's okay. That's like the only bond. But whole life insurance is a triple A rated, one day callable piece of paper. In English, it's one of the safest assets you can own in America. It's safer than the money in your bank account, and it's safer than a 90-day treasury bill. I'll tell you why.
Yeah.
A 90-day treasury bill is arguably the safest bonds that you can buy in America. It's an American bond, which is only 90 days. But the treasury bill has a higher standard deviation or measure of volatility than a whole life insurance cash value. So it's extremely safe. I can't tell someone whether buying rental properties is better. All I can say, and I'm really true to this, is diversification. It's all about diversification. And that's why I mentioned when we was just explaining how flexible it is, it complements additional financial strategies that you have in place. A true financial advisor or a true advisor of any sort should not be advising their clients to put all their eggs in one basket. Oil and gas strategies are great within our group and many people. I don't think it's always the best strategy, but I think it's one that people just know a lot about, but it's also very risky. When you're looking at the risk of an RPT versus that, the RPT wins all day long in one of the safest vehicles that you can fund, as long as you maintain that payment for 5 years, 10 years, or 15 years. And as I said, after each 5-year increment, you can analyze the business, see where the business is going, and make sure you've got enough reserves to make those contributions on an annual basis. I'm only going to speak about that, but like as long as you're diversifying and you're not just in property, so you don't get hit in what we saw in the subprime mortgage collapse, you just got to make sure that all your eggs are not in one basket.
No, that's really good advice. I have heard that people get rich from focus and really going deep into one strategy, but they keep their wealth with diversification by not having all your eggs in one basket, and that, to me, that made sense because I was very heavily invested in real estate. I still am very heavily invested in real estate over any other asset class, but it made sense to have a few different buckets so that if tax laws change, if the economy changes, if there is ever a lawsuit, something that creditors were coming after me and I lost property, that having some sort of a benefit, cash value insurance policy where you have a guaranteed return, guaranteed death benefit, and guaranteed income benefit, essentially, where you can draw money from that, regardless of lawsuits, divorce, other things like that. It's nice to have a source of income that's completely separate from other things and protected. So that makes sense to me.
Well, just on that protection side as well, I don't know. There's so many different oil and gas strategies out there, and some of them have been scrutinized, and you need to make sure you're doing the right thing. The RPTs have been around for 20 years. In that 20 years, I believe it's 2 or 3 times the IRS questioned the strategy, and they've got a 100% record. They beat the IRS in every case. It's now embedded. It is a extremely safe IRS proof strategy of putting in pre-tax dollars and taking the majority out, tax free. Unlike other tax deferral strategies that might carry the potential for fines or penalties from the IRS, the RPT has been fully vetted and legally upheld. So it comes down to just making sure that you are aware of the potential risks in some of the strategies that you're doing. Because like you said, man, like some people are looking at, okay, I'm trying to legally, of course, avoid paying as much taxes as I can, but sometimes they can get blind because they're so focused on the legal part of the tax avoidance that they're actually not moving into the best strategy for them.
Yeah, no, that makes sense. That does make sense. Can you tell me what are, not necessarily the downside, but what? Yeah, because I'm sure, as you said, it depends. where it could be right for one person, not right for another person. If you're to say some generalizations of roughly income amount where it would make sense? You mentioned 500,000 or above. And what would the minimum amount somebody could put in, maximum, if there is a maximum,
Sure.
and also what would the fees, typical annual fees or monthly fees look like for a typical plan?
Yeah. So, okay. So when it comes to, so first and foremost, what I see as the biggest risk on an RPT, you have to make contributions for a 5-year block.
Mm-hmm. Mm-hmm.
If you do not make a contribution for any reason, business folds, you can't afford it, whatever, then the proceeds of what you put in, the cash value, will be donated to a non-profit of your choice. Okay. So sounds scary, doesn't it? But then when someone's earning 800, 900 or 500 or more, you need to right size it to make sure that it's an amount that they can put in. If someone says, this is amazing, I want to put 300,000 in, I'm going to be like, well, we should talk about that. Maybe you should start on a smaller number. So it's all about getting the right amount in there. But that's what I see as the fundamental downsides. Now, when you put that against a traditional whole life policy, it's actually no different. In the whole life policy, if you can't make a payment, then the same thing happens, but the timescales are a lot longer in some of these traditional whole life policies. If depending on which one you did, you could be paying a whole life policy for 20, 30, 40 years. Whereas this is a 5-year increment. So it's a lot smoother in that sense. The participant minimum is $50,000.
Okay.
The trust minimum is $100,000. So if one person does it, it's 100,000. If two people do it, the minimum is 50,000 each.
Got it.
3 people will be 150 on the minimum sides. So that's how it works on a participation. It's 50,000 per participant, and it's 100,000. I don't want to give because we're on a podcast, so things might change. But in terms of like any additional costs, there are some one-off costs. It's around $5,000 just to set up the trust. So that's like more of like a one-off cost that might go up or down, but it's around that figure. But it's minimal compared to what you're contributing because you're setting up this thing pre-tax dollars, and around $1,000 for the trust one-off per participant. So once you've got those out of the way, the ongoing costs to maintain this, but once again, it's pre-tax dollars going in, is around $1,500 on an ongoing basis. I'm very clean on that to make sure that you just send everything out so people know, but we've never had any issues with that because once again, it's pre-tax dollars going into the account and you're saving a lot of money on the backside. And I probably just for some listeners out there, Garth, and something we didn't talk about, how the mechanism works. And I told you it's 5, 10 or 15 years. I'm just going to use 10 years as the average and pretending it's 100,000. Okay. It's one participant. After the 10-year period, 100,000 times 10, you put in $1 million. Okay. What's actually happened every year is you've got an 83B election. So kind of like a phantom income that's deferring every year until you no longer pay, until you finish the policy, where it's 5, 10 or 15 years. And after that, you actually do pay taxes on 30% of the contribution. So 70%, or in this example, $700,000 is completely tax-free. And you pay for the 30% with the cash value that's being accumulated on the policy, which has been growing every single year, compounding. And then once that's paid off, you're no longer paying into the policy, and you've got this substantial amount of cash value, which has grown pre-tax, and you've got its death benefit as well. So you've got the best of both worlds.
And is that paid out in one, like after the 10 years, is that paid in like a one lump sum, or is that over time, over a couple of years, or how does that work? Say that, say the $1 million example.
So once again, it's financial planning 101. So it depends on what the client wants. But generally how we set it up is we just leave it. It keeps on growing, compounded. It's now a really effective savings plan, like a really effective high level, high yielding cash plan, like a bank account, so to speak, just growing cash value. And then how we usually structure it is depending on the age of the business owner, we wait until a certain age, whether it's 50, 60, 65, and actually start drawing an income, a tax-free income from that. So they've got this additional income stream tax-free from this policy for the rest of their lives.
That makes sense. On that note, how would you compare it to a 401k? I think most dentists, for better or worse, and really most professionals in general, typically invest in some sort of a 401k. And I know there are pros and cons with that. And how would this compare to, like, say they're not doing any real estate, they're not doing any other tax strategies? How would you compare this to a typical 401k plan?
The 401k is capped fundamentally is the first thing. Secondly, depending on the tax rate at the time, you are going to be taxed significantly on the distribution part of that 401k. Thirdly, that 401k is invested in the stock market. And it doesn't matter how successful you are. No one wants to be sitting on their rocking chair in their front porch, drinking their peach lemonade or whatever, wondering what's going to happen to their investment when the next stock market crash happens. Now, all of that being said, my favorite thing to say in financial planning is it's never an or, it's an and.
Sure,
and so,
that makes sense.
It's diversification 101. So I would say the 401k is invested in the stock market, the RPT is not. And as mentioned earlier, it's the equivalent of 7% in the stock market year on year without a downward market. That sounds like a pretty good deal to me. 7%
I agree.
Every single year, and with no downside is pretty good. Okay. And then so it's not invested in the stock market. It's growing tax-free, but you can also take it out tax-free. So we're not comparing apples to apples here. We are comparing two awesome ways of building wealth and diversification. I'm not going to bash a 401k because I did that for all of my career before getting into tech, but it's never an or, it's an and. And if you've got excess cash that you're paying taxes on anyway, the RPT would be a great idea.
That's a really good point. If you're going to be paying $100,000, $200,000 in taxes anyways, if you could reduce that by doing something like this and you don't have a better investment option, that sounds like it's a pretty good investment strategy. And it's guaranteed. It's a guaranteed return, like you said, not like Tony Robbins' book on money, where he talks about how they say the average stock return is 8 or 10%. It's somewhat misleading because it's really not. When you count the highs and the lows, they don't traditionally get that average that you would think it was. And so, whereas this would be, if it's 7%, it really is 7%.
Yes, it is. Yeah. And yeah, to your point, it's like time in the market versus timing the market, because you tell someone that return over 2002 to 2022, it could be a completely different market gain from someone in there from 1970 to 1990, for example. So it's just like it's you're right. It's you can't make a generalization on that because it depends when you got into it, and sadly when you get out of it. Some people took their money out when COVID started, thinking the world was going to end, and that was one of the quickest rebounds in recent market history, where some people sadly lost 40% of their investments. And so it's nice to have something which has got that growth rate, which is consistent.
No, that's awesome.
And it's building legacy, man. Like that's the main thing. Right? Like this is really the best of both worlds, because it's something which is high cash generating, but you're also ticking the life insurance box as well, because you're leaving money to your loved ones if, God forbid, something happens to you. If you're doing the like-for-like contribution to the markets and you get hit by the proverbial bus tomorrow, there's no added death benefit there, whereas this gives you a big death benefit as well. So it ticks that legacy box.
Awesome. Thank you, Sam. On a different note, but similar, overall strategies, if you were to make a couple general strategies on some good financial planning throughout life, what would be maybe some of your top strategies or recommendations you'd make in particular for dentists or doctors?
Yeah, I mean, really, one thing that a lot of people are taking advantage of is getting into short-term rentals using depreciation. I think that's a really good tool, and obviously you speak a lot about that. And then, just making sure that you're taking advantage of the strategies that are already available to you, like maximizing your SEP IRA contribution, looking into that, your 401k, making sure that you're putting in pre-tax dollars. You are going to get taxed on the back end, but having that, so it's at least growing, compounded with pre-tax dollars. And then, like I said, I mean, there's different strategies out there. You mentioned some of them in the beginning, oil and gas strategies. I'll just advise you to do a little bit more scrutiny on those to make sure that you're getting into the right thing. You know exactly what's happening. And then, of course, this new strategy that I recommended, like I said, the majority of my clients are in that space. So that would be a good alternative too.
That's awesome. That's awesome. Good. As far as books, I know you study a lot and are very well versed in a lot of different areas. Any book recommendations that have moved the needle for you in the last couple of years?
You say most of your audience are overachievers.
Well, to be a dentist, you have to be somewhat of an overachiever because, it's not an easy road to get there.
That's right. I would say 10X is easier than 2X by Dan Sullivan and Ben Hardy.
Awesome. A great book.
Just a great book. I don't want to give it away, but the opening chapter with Michelangelo and how Michelangelo became Michelangelo is just astonishing. Risking his life literally every weekend to open bodies and do surgery to become better than any doctor, when all he wanted to become was a sculptor and a painting artist. And it's just it's quite phenomenal, the depths that you will go through to master your profession. And 10X is easier than 2X is essentially saying, if done correctly, you can get 10X results faster than 2X results. I would highly recommend it.
That's awesome. That's awesome. So Ben Hardy, was Dan Sullivan on that one too? I think I've
they've been doing a lot of like books together.
That's awesome. That's awesome. Good. Any others? That's a good solid one, huh?
I'll say I mean, there's a lot. There's thinking of some that comes to mind that I really like. Do you know what? I'm going to keep it basic. I'm going to say, and I still have to read this book once a year just to kind of remember where I'm at. If you haven't read it, I would highly recommend James Clear's Atomic Habits. I really would.
Oh, good.
There's so many good nuggets in that. People forget, and I still learn from that book every year.
No, that's fantastic. One other question. If Sam lost everything and you had to start again from scratch, you have your knowledge, but no finances, no contacts, where would you start to rebuild the empire you've created?
Okay, so I've lost everything. Do I still have my contacts?
Let's say for this sake, no contact. You have your knowledge, but not necessarily the people that you know. No contacts right now.
I still got my knowledge.
Yes, but you still do have your knowledge.
I mean, I'll go back to tax strategies, right? And going and educating people. And if I've got no phone as well, I'd have to start by knocking on people's doors, man. But I'll have to tell them my experience, at least my knowledge experience, and what I can bring to the table for international financial planning.
That's awesome. No, that's a good answer. That is a good answer. And that is the cool thing with knowledge, is that's one of the things people can't take from you. I've always, at least as a business owner, have invested in mentors, in coaching, in masterminds, things like that, in books, CDs, podcasts, all those things, because your knowledge is one thing you can't lose. I mean, that's probably been my best investment, is investing in myself, but by gaining that knowledge, be that from others, and preferably others. I learned as well from experience, but experience is usually a lot more painful than if you can learn from somebody else's experience. So I like that.
Oh yeah.
No, it is good. Sam, you mentioned a love of history, which I also enjoy history, especially U.S. history, but even world history. It's amazing. When I was in the military stationed in Germany, to visit Europe and go throughout Germany and France and England and Switzerland and Italy and see so much history. In the U.S., we think if something was built in the 1600s, it's ancient, and yet the town I lived in Germany was established, I believe, in 1297 or something like that. I mean, before Columbus discovered America, and to see the Colosseum and things that have been around prior to the time of Christ. And it's just amazing. And so with history, what are things that you enjoy about history, or lessons that you learn now and for the future?
I love that. And obviously being from the UK, there's pubs that, are nearly 1,000 years old. And it's just so cool getting to see and experience that. I think history is so important, that fundamentally important to who we are and where we're going. I read an article a couple of years ago that scared me, and it said history as a subject is one of the fastest declining subjects, which really scares me, because it means that we can be heading into a world where we're ignoring all of the lessons, recorded lessons that lead to division and potentially greater than division and destruction. And I just think there's so much to unpack. And for me, I like to go far back in history. I like the ancient Egyptians. Most people don't realize that the Sphinx is about 12,500 years old.
Wow.
So people think it's all 2, 3, 4,000. The ancient Egyptians were studying ancient Egypt. And so when you start looking at that, there's so much history and to unravel on that part. I just find it super fascinating. I get into deep rabbit holes of, what was really happening back in those days. And if you really look deep and listen to the data, sometimes there's what we're told is not necessarily true. And I really enjoy that part of it, to kind of figure out, what was actually happening back then. And it's always going to fascinate me. It is my favorite thing in the world. And I think it's important for everyone. I think it could shape some people if they truly know, history and how to implement that for the future.
That is so true. Well, and history definitely has a way of repeating itself. And it is amazing how technology comes out, and there's so many different advances and changes, and yet human psychology, human nature is so much the same throughout history. You read somebody like Marcus Aurelius and different mindsets that he had, and how he approaches problems and war and dealing with people. And it's all the same issues that we face today, as far as being kind, and issues with jealousy and finances and arguments, and just the same nonsense we all have been dealing with, for centuries,
Yeah. And what's really interesting as well? Like, most people won't realize this, but the first electric car that came out was in 1882.
Wow.
By Thomas Parker, an Englishman. And he was driving it around England. Okay, there's a massive piece of history on electric vehicles that most people don't realize, because of the American Industrial Revolution, especially in the automobile sector, with you can have any color as long as it's black, T-model Ford, and getting that Ford out. And internal combustion engines won the race for the foreseeable 100 years. But when people are questioning the EVs and whether it's going to be around, I've got a strong yes for that, because it's not new tech. They've made the technology better, but when you start looking back at history, you can learn a lot. You can learn a lot from history.
Oh, so true. Anything that would be beneficial, you think, to cover for Dennis financially that I didn't ask, or maybe something I should have asked that I have not asked?
No, I've really enjoyed this. This was great. Awesome. You covered all bases.
Well, likewise, Sam. No, you've dropped a lot of knowledge and a lot of information. I know my wheels are turning. I'm sure most of the listeners are as well. If someone wants to get a hold of you to learn more about these strategies, either the RPT or any other financial strategies, Sam, what would be the best way for them to get a hold of you?
I think the best way is just dropping an email, sam@syedfinancial.com. So sam@syedfinancial.com, or you can just go to the website, which is syedfinancial.com.
Awesome. Fantastic. We'll put that in the show notes. So thank you so much, Sam. Really appreciate that. Appreciate all the knowledge you've dropped. Appreciate our friendship. You're a great guy. And I love how you're always growing and stretching and trying new things and doing incredible things. So very admirable. So thanks for all you're doing, Sam, and thanks for the knowledge and wisdom you dropped.
Thank you. Yeah, I love this. Thanks so much.
All right. Thanks. And thank you, Lifestyle Dentist. And look forward to, we've got an upcoming event in Cabo San Lucas. Looking forward to that and looking forward to connecting with each of you. So best wishes. Take care. Thanks. Bye-bye.